Today, who rates the raters? The DFA Daily to the 8th of April 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. Late to the party, as always, the global ratings agencies are now starting to take the global economic slowdown seriously. Worth recalling, of course, that they missed the warning signs more than a decade ago at the time of the GFC. So I guess the question is, does it really matter? Well, first cab off the rank was S&P Global Ratings, who revised the outlook on its long-term ratings for Australia to negative from stable. This, they say, is because Australia faces fiscal and economic risks that are tilted towards the downside. They warn that they could lower their rating within the next 2 years if the health issues cause economic damage that is more severe or prolonged than they currently expect. With household indebtedness at elevated levels, this could delay the process of repairing the government balance sheet beyond what they currently expect. Government indebtedness and interest costs will remain at elevated levels. On the other hand, they say, in their upside scenario, they could see the outlook reverting to stable if the general government fiscal balance improves in line with their expectations as the economy recovers, or if Australia's external position improves. Stronger fiscal and external positions would improve the sovereign with a buffer to absorb another potential economic or financial shock. Now, it's worth at this point referring to the Grattan Institute blog. It's actually a very good source. And they said as exponential growth takes hold in a country, new weekly cases grow so quickly that they make up almost the entire total. Countries on this path move diagonally, but as new cases start to slow, countries turn a corner. 5 countries are highlighted, some with trajectories like Australia's, others not so. The United States and the United Kingdom have several weeks of exponential growth with little sign of slowdown. China hit 80,000 total cases and then sharply turned the corner, reducing new cases dramatically. But while new cases have fallen in China and South Korea, like it, new cases have lingered at between 200 and 600 per week. This shows that getting to near zero new cases is not a given after countries slow the spread. Singapore minimised the spread early by tightly controlling its borders and implementing broad contact tracing, but it then had a dreaded second wave, a second round of rapid growth in new cases. In response, Singapore has tightened further, introducing more stringent social or spatial distancing measures, closing schools, and ordering non-essential workers to work from home. Australia has turned a corner, but they say we cannot afford to become complacent. Relaxing our spatial distancing efforts could result in the number of new cases in the community increasing again. Lifting our restrictions too early could result in a second wave of rapid growth. And so the message from Grattan's new graph is clear. Australia must be careful about when we lift restrictions, what restrictions we lift, and in what order. And that is the key point, because if the ratings agencies are right and things bounce back quite quickly, then perhaps their estimates are spot on. But if, as we think, this is going to grind on for lower and longer, then they're probably not on song yet. And going back to S&P, either way, they say Australia has been dealt a severe economic and fiscal shock. They expect the Australian economy to plunge into recession for the first time in almost 30 years, causing a substantial deterioration of the government's fiscal headroom at the AAA rating level. The large budget deficits that they project in fiscal years 20 and 21 are likely temporary and do not represent a structural weakening of fiscal performance. Net government debt and relative interest rate costs, nevertheless, are likely to remain at elevated levels for a number of years. Along with its strong institutions, they say, a credible monetary policy and floating exchange rate regimes, Australia's typically strong fiscal performance remains a credit strength for the rating. Australia, meantime, remains susceptible to vulnerabilities associated with its high external and household indebtedness. They expect the general government deficit to average around 7.5% of GDP between 20 and 21, before narrowing sharply. We believe the change in net debt will return to its structural level of 0% to 3% of GDP per year after the effects of the health crisis pass through the Australian system. Revenue headwinds, including company and personal income taxes, consumption taxes and property conveyance duties, and rising social welfare payments and health costs, will drag on Australia's general government balance during the next few years, even as the government's large stimulus packages cease. The Commonwealth, and to a lesser extent state governments, have launched large fiscal stimulus packages worth about 3.8% of GDP in fiscal 2020 and 7.2% of GDP in fiscal 2021. These are designed to be temporary and are targeted at supporting the economy and workers during the next 6 months. While fiscal stimulus measures will soften the blow presented by the current crisis and weigh heavily on public finances in the immediate future, they won't structurally weaken Australia's fiscal position. This expected improvement is a key supporting factor to the AAA rating. And they also mention that the property outlook is uncertain, with open houses and auctions having been restricted and a wide range of businesses closed as the government tries to limit the spread of the crisis. They expect a decline in transaction volumes rather than a sharp fall in prices during the period. Good luck with that, with prices aided by record low interest rates. House prices, which remain relatively high to incomes, picked up strongly in the first half of 2020 following an orderly unwind between 2017 and 2019, and they expect bank credit to non-government residents to fall in the current environment while remaining very high at around 165 to 170% of GDP, including interbank lending. An abrupt disruption in the property market, which is not their expectation, could lead to vulnerabilities in the finance sector and fiscal and economic stability. And they consider Australia's banking system to be one of the strongest globally. Along with the high-income Australian economy, this reflects the low-risk appetites of the major banks, which dominate the industry, and is supported by conservative and largely effective regulation. However, risks remain elevated as a result of a long period of high house price inflation and rising household indebtedness, including debt for unincorporated businesses. They consider Australia's economy to be vulnerable to major shifts in international capital flows. Even though the current account deficit narrowed in recent years, they believe the economy carries a high level of net external debt at 250% of current account receipts, or CAR. Volatility in the country's terms of trade and a large stock of short-term external debt. Australia's short-term external debt, which is mostly bank debt, will also remain high at more than 150% of CARs. And its high level of external debt has been exacerbated by historically high current account deficits of more than 10% of CARs. Current account deficits have narrowed to an estimated 1.5% of CARs between 2020 and 2022, and the volatility in the country's terms of trade is beginning to decrease, they say. Australia's external debt is mostly generated by the private sector and reflects the productive investment opportunities available in Australia, foreign investor confidence in Australia's rule of law, and the high creditworthiness of its banking system. A portion of Australia's external debt has also funded a surge in household borrowing for housing in the past decade. We expect Australia's external borrowers to maintain easy access to foreign funding. And the Reserve Bank of Australia, the central bank of course, has maintained a freely floating exchange rate regime for more than 3 decades, and the Australian dollar represents a little more than 1.5% of allocated international reserves as at September the 30th, 2019. And they say the currency is represented in a comparable percentage of spot foreign exchange transactions. Australia's domestic bond market is deep, and although external borrowing is high, it is mostly denominated in the nation's own currency or hedged. And Australia has a high degree of monetary credibility via the independent RBA. This should help the country to temper major economic shocks, such as the current issues, as it did during the global financial crisis in 2008-2009. And they believe the RBA has successfully anchored inflation expectations over many years. However, it has struggled to achieve its inflation target in recent years as unemployment and underemployment remain stubbornly high. And the RBA has responded to the current shock by cutting the overnight cash rate to 0.25%. It has also begun undertaking controlling the yield curve of 3-year Australian government securities and state government securities by purchasing bonds in the secondary market. Its aim to keep the yields at around 0.25%, which should flow through to the economy and help facilitate the smooth functioning of Australia's bond markets. And Westpac said of S&P's revised outlook that long-term debt rating from stable to negative is similar to the actions they took in July 2016. A negative outlook implies a 1 in 3 chance of a 1-notch downgrade in the next couple of years. And S&P expects the economy to substantially weaken before recovering towards the end of 2020. And as indicated, this rebound towards the end of the year is a critical assumption in whether or not the sovereign will be downgraded. And on the budget position, S&P expects the general government deficit to reach 5.5% in 2019-20, extend to 9.5% in 2020-21, which is an average of 7.5% across this financial year and the next. So the question you have to ask is, does this actually mean anything at all? Well, Westpac's view is that there will not be any major repricing of Australia's risk-reward profile, and the initial responses in both bonds and the currency seem to concur, as both have been muted, with yields across the curve basically unchanged, and the Aussie-US dollar cross lower by only 30 ticks. And then Fitch Ratings downgraded the issuer default ratings, the IDRS, of Australia's 4 largest banking groups and their New Zealand subsidiaries to A+/F1 from AA- to F1+. And it reflects the agency's expectation of a significant economic shock in the first half of 2020 due to measures taken to halt the spread of the health issues, followed by a moderate recovery through 2021. The ratings on the banks had limited buffers at the previous levels, they say, as reflected in a negative outlook on the IDRS, with an economic shock and further profitability weakness as stated downgrade triggers in recent reviews. Buffers are more substantial at the new rating. Nevertheless, further downside risk remains to their baseline case, which is why a negative outlook has been retained on the ratings. And Fitch has revised the outlook on the operating environment score for banks in both Australia at AA- and New Zealand A to negative from stable as part of this action. And the agency expects GDP to shrink in both markets in the first half of 2020, with only a modest recovery starting in the second half of 2020 and extending into 2021. Unemployment is likely to spike sharply and remain very elevated relative to pre-pandemic levels even after the recovery is underway. The current operating environment scores incorporate this base case, and the outlook on this factor would likely be revised to stable should the baseline case scenario eventuate. Conversely, they say, a significant extension of the downturn into the second half of 2020, or only a shallow recovery that results in much weaker economic conditions through 2021 and beyond, could result in a reduction of the score in both markets. The implications, per Fitch's criteria, are that they'd expect banks to maintain stronger financial profiles, particularly for key financial metrics, than is the case with an operating environment assessed in the AA category. And they expect these conditions to affect asset quality and earnings in particular, with the midpoints of both factors reduced by a notch for the large Australian banks with negative factor outlooks. Support measures implemented by the government, regulators and banks themselves should alleviate some of the asset quality pressure which will emerge from the downturn, particularly within the next 6 to 12 months. However, they expect that a proportion of businesses will fail to restart once the recovery begins, and some households will not be able to resume debt repayments after the repayment holidays provided by the banks. As a result, asset quality metrics will likely weaken from current levels over the next 12 to 18 months, and they expect them to no longer be consistent with a AA- factor. Stage 3 loan ranges from 0.9% to 1.3% of gross loans at the most recent year end for these banks, and Fitch typically expects these ratios to be sustainably under 1% to be consistent with a score in the AA range, although the Australian and New Zealand banks benefit from a high level of secured lending, which would help limit losses. And they say earnings will face pressures from both higher impairment charges and lower interest rates. And the central banks in Australia and New Zealand have cut their respective cash rates to 0.25% and indicated they will remain there for a prolonged period. So the bank's earnings were already vulnerable before the crisis hit, which was reflected in the negative outlook on the factor. The challenges from the outbreak are likely to exacerbate this pressure. Capitalisation of these banks will be affected by the weaker asset quality, but buffers built in recent years should be sufficient at current scores under their base case, and they have retained a stable outlook for this factor. Funding and liquidity is supported by sound liquidity management and the significant support provided by the Australian and New Zealand central banks, with limited short-term pressure likely. The outlook for this factor remains stable as a result. The funding and liquidity scores for all banks are already lower than their respective viability rating, reflecting a high resilience on offshore wholesale funding. And Fitch reviewed the 4 large banks in Australia and New Zealand ahead of the rest of the portfolio, as the outlook on the IDRS were already negative, indicating greater susceptibility to a downgrade at their relative rating levels and a higher likelihood that they would hit previously stated downgrade sensitivities. In addition, the banks combined account for a significant majority of banking system assets in both markets, and they will review the remaining Australian and New Zealand banks rated by Fitch in the near future. And right into the middle of this, Regional Bank of Queensland released their first half results today, and these demonstrated the pressures in the system before the health emergency. Their cash earnings fell 10% on the prior period to $151 million, and following APRA's request that banks and insurers limit discretionary capital distribution in the months ahead, the bank announced that they would defer the decision on payment of an interim dividend until the economic outlook is clearer and stress testing results have been discussed with APRA. The CET1 capital was 9.9%, and the bank claimed that they were in a strong capital position to manage through potential downside impacts ahead. Total mortgage growth increased by 1.7% over the half, but branch network runoffs have continued. And Bank of Queensland's non-housing loans growth remains strong at 1.8% over the half, with particularly strong growth through the commercial channels, with a focus on certain niche industry segments. Overall, its business lending growth for the half grew at 2.2 times system growth, but looking ahead, we suspect that this may slow, although the Bank of Queensland noted that home and business loan application volumes are still holding up, although this could change quickly, while the repayment holidays will limit declines on the growth of loan balances. Their first half 20 net interest margin was down 3 basis points to 1.89%, thanks to funding, mix and cost down 5 basis points, and they were broadly offset by asset repricing and mix up 6 basis points, in other words, taking margin off depositors. Further, there were headwinds from capital of around 3 basis points, third-party costs at 3 basis points, and liquidity at 2 basis points, which were all partially offset by the benefit of hedging costs at 4 basis points. But The bank said margin pressure on mortgages was abating as deposits are becoming more competitive, and they expect the net interest margins to be broadly flat in the second half. Fee income was $58 million and down 11% on the prior period as banking fees remained under pressure. Trading income contributed $2 million and St Andrews Insurance improved sequentially and made a $6 million contribution. Management flagged the expectations for fee income to continue to decline, given consumer demand for low and no fee products. Bank expenses were $292 million, up 9% on the prior period due to increased expenses from risk and regulatory programs and investments in technology projects. And their bad debt charge was 13 basis points, and that was down 7 basis points on the second half 2019. Now, they did make a collective provision of $10 million for the virus, but this is remarkably low. Their current estimate for the impact in the financial year 2020 was somewhere between $49 and $71 million, inclusive of that $10 million already taken. And as for capital, Bank of Queensland's first half 20 CET1 ratio was 9.91%, which compares to Bendigo at 9% and Suncorp's 9.7%. And they say they've raised enough capital for now. And Bank of Queensland's net stable funding ratio remained flat at 112%, and its liquidity ratio was 133%. And they say that they're going to run a more severe stress test scenario where unemployment increases to around 10%, and their modelling suggests that their CET1 ratio remains within their target range of 9 to 9.5%. And meantime, from the ABS comes the February new housing finance, and it came in softer than expected, with the total value of approvals recording a 1.7% decline in the month against expectations of a modest rise. It was soft across most segments, and this was before the health crisis really hit. Owner-occupied volume slowed, with the number of loans in this segment down 2%, but the value down only 1.7%. The number of approvals, though, is still up 4.9%. Since the low point back in May 2019, while the total value was up 22.6%. So that implies larger loan sizes, which is consistent with bigger prices and also looser lending. Investor activity remains subdued. The value of investor loans saw a slightly bigger decline in the month, down 1.9%, with the value of approvals up 6.3% over the year, compared to the stronger owner-occupied loan growth. Construction-related loans showed a 1.9% rise, largely supported perhaps by activity around bushfire rebuilding. But loans for the purchase of new-built dwellings fell sharply, down 8.9% over the month, after some very strong gains over the previous 3 months, and they're still up 29% over the year, although the ABS has identified some data quality concerns with these measures, and we'll probably see later revisions. On a combined basis, the total value of loans was up 1.7% over the month and 13.1% over the year. And by state, weakness was concentrated in New South Wales, where the loans dropped 7.1% over the month, South Australia down 7.2%, and to a lesser extent in Victoria down 2.1% over the month. Other states, though, recorded gains, with Queensland up 4.1% and Western Australia up 5.5%. But frankly, this is all pretty academic now, as any softness before the crisis will pan into insignificance in the light of the economic slowdown ahead. Auction markets have already registered an abrupt slowdown, as physical auctions have been banned outright, although half of auctions have been withdrawn prior, and the remaining sales going via pre-auction sales or online auctions so far. This segment only accounts for around 15% of all property sales, and the industry may do more to adapt to the situation in coming months. We'll see. Nevertheless, health concerns, social distancing restrictions, and a deep economic shock will heavily impact the wider property market in coming months, which is why we think the property prices will fall. And to round out today's update, more relief packages from top economies have been announced aimed at fighting the shock. Japanese Prime Minister Shinzo Abe announced the details of a massive stimulus package on Monday worth 108 trillion yen or 990 billion US dollars. The scale, which is 20% of Japan's GDP, is unprecedented. The program includes 6 trillion yen or $55 billion in cash handouts for families who have lost significant income and small business owners. There is also 26 trillion yen or $238 billion for emergency loans for Japanese corporations to keep employers on their payroll. And expect even more stimulus, as German media reports that the country could allocate 50 billion euros or $54 billion to jumpstart the economy as the crisis continues. And Goldman Sachs told clients on Monday that it thinks the US Congress will enact at least one more fiscal package that includes aid for state governments, as well as additional funding for small businesses, and possibly another round of checks for individuals. So we continue to see the downdraft from the slowdown, and it must be getting real when rating agencies finally wake up to the consequences, even if they're understating the impact. And by the way, following feedback from our live event last night, one of the most popular we've run, we won't be reporting the market movements every day, but obviously if something significant happens, we will, of course, call it out. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.